So welcome everyone. Excited to talk to you today. It's been a while since I've done a webinar for an apartment deal. I've been raising money for our TV show, our kids' TV show. So we've raised about $5 million. I know some of you that are on the call are in that project. I'm grateful and thankful that you have came in and supported us on our TV show. It's called Kids Who Flip. So if you don't know about it, would love for you guys to just watch it on TV and support it. But that's kind of where I've been had my focus for the last year. And then we've been saying no to a lot of deals personally. I have a lot of people that ask me to raise money for their projects and things, and to put my money in places. So I know some of you are here for a couple different reasons. One, you might be here to kind of see how we present a webinar. So you might have come to some of my challenges or workshops or things like that about raising capital, and you might be here to see kind of how we give a presentation. Welcome. Number two, you might be here because you want to do something like this yourself, right? You want to build new construction apartments or flip apartments or just houses or whatever it is. And then third, you're probably a accredited investor that wants to invest in a deal with us and just kind of see what we're doing. So I'm personally investing in this deal. I know I won't speak for Adam, but I know Adam's planning on investing in this deal as well. And I like to bring my friends along with me and people that I know and are in my network. So we're building something here, and we'll talk a little bit about how this works. But I've got Jay Scott. A lot of you guys know Jay Scott from all the books that he wrote, his time, all over Bigger Pockets. A lot of the time he spent, building a brand, and I love following him and reading his take on money and the market and things like that. Just came to speak at our seven-figure flipping event recently. It was absolutely incredible. One of the biggest feedbacks we got of the event was how great he did. And so I'm excited to be partnering with him for the first time on a project like this and structuring it such that we'll probably talk about it a second, but I think a lot of people are not doing this correctly. They're actually raising money for other people's projects where they're not actual general partners, and we'll talk about how that works here. And then doing this right, where we're actually building a fund to invest in Jay's deal. So we're going to talk about that, doing it legally, doing it compliantly, doing it the correct way, and hopefully, over the next a few workshops that we do around raising money, I'll talk to you about how we do that, how you can do it as well, and what that looks like. So an amazing project outside of Dallas. Let Jay talk a lot about that. But if you don't know who I am, my name is Bill Allen. I own a company called Seven Figure Flipping. I've been flipping houses for about 15 years now and investing in apartments myself as a limited partner for probably about 10 years now, and then as a general partner for the last 5 or 6. We've actually, me and some other partners of mine have actually taken about 23 apartment buildings full cycle at this point, which is really exciting. Made some great returns for our investors. We haven't always won at the level that we thought we were going to win, but I'd say our track record is pretty good at this point. And I love, putting my money in all of my projects and then bringing you guys with me. I was in the military, flew for 20 years, helicopters and airplanes, and spent my time doing that, retired a couple years ago. Adam, I'll give you a chance to introduce yourself, and then we'll hand it over to Jay to kind of talk about the project.
Yeah, awesome. Thanks, man. So for those of you who either don't know me or have invested with me in previous apartments, and my name's Adam Whitney. I'm actually the CEO of one of Bill's partners in a couple different companies, but we flip houses still currently. And I've been buying apartments with my apartment investment group in 23 and 24. We bought about 350 units, but in 25, we didn't buy anything because things weren't penciling and we weren't going to rush into a deal that wasn't good. So I've been personally on the hunt for a good deal that I could put my money behind and participate in, and was grateful that this came up. And this is something I'm personally putting cash in, as Bill said. And like you alluded to, Bill, is like, if I'm going to put my money there and I don't have another apartment that was fitting what we were doing previously, this is as good or better in a lot of ways. So I'm really excited to bring my friends along on this as well, and to partner with both you and Jay on this. I mean, this is an absolute all-star team of operators and real estate investors. So grateful to be here. I'm excited for you guys to get to see this and see a pro like Jay come in and show you how he structures these deals and why this particular deal is so amazing and why I'm wanting to put my money in it. So welcome to those of you who showed up that I invited. And for those of you that I didn't invite, nice to meet you guys.
Yeah. Hey, before we keep going, Will, what's up? Anessa, hello. See some like amazing investors and people. Brett, welcome. Calvin, hello. Christian, hello. It's good to see all you guys, and it's awesome to see all these friends of mine and people that I know that are on this call. So really excited. All right, Jay, I'll give it over to you to kind of talk about the project. And before I do that, I want for those of you who don't know Jay, I just want to give a quick introduction from my side of like where I came from. I remember there was this book. It was called The Book on Flipping Houses, and I bought this book, and this was at a time where like it's probably the first and maybe only book I ever bought. I don't know if you guys know my story, but I was so cheap that I had a library card and I would wait like 2 or 3 months to actually like till the book was ready. I had this Overdrive app on my phone, and I would wait until it was available on the at the library to actually like listen to the book or read the book. That's how cheap I was. Like never paid for a conference ticket, never paid for a mastermind, never. I don't know. I was on Bigger Pockets. I was all over it. I was posting about stuff. I was learning. I was watching the TV shows. And on that site, it was always people were like, "Don't pay for education. You don't need to pay for education." And I literally took that to heart. And for years and years and years, I never did. So I know a lot of you guys are in my mastermind that are on the call, and I'm grateful that you're there and you do pay for your education and networking and stuff. But I bought this book. I still remember. I was like, I don't remember what it was, Jay. It was probably like, I don't know, $15 or $20. Maybe it was $50 at the time. Like, right. And it had the bonus bundle with the spreadsheet with it and all the estimating repair costs, like those two books. So I read those books and I flipped my first house in Southern Maryland. So I bought this house in Southern Maryland, yeah, outside of Patuxent River. It was in a place called California, Maryland, Lexington Park area, if anybody knows it. And I just used that book. Like I used the book. I was like, I have no idea how much flooring costs. And it was all in there. Like it was like low, medium, high tiers. And I'm an engineer. So like if you give me a map, I can follow it. And he wrote the map. And he was like a virtual mentor of mine for many, many years without even knowing it. I was like, I'm never gonna meet Jay Scott. Like this guy's like huge in the Bigger Pockets world and right. And I mean, I was, a helicopter pilot at Test Pilot Squadron, and had a couple rental houses, and I was trying to flip my first house, and I literally just followed it to a T. And when the contractor gave me bids, I would compare it to what was on there. And for prop, I sold that house. I made $43,000. So half my military salary completely changed my life and gave me like the belief that I could do it. This is before like I was listening to podcasts and I was using that book. Then I did another one the next year. I moved to Pensacola. I did my next house. I used that book again. I flipped it, made $45,000. I'm kind of hard headed. I need to prove that I can do it over and over again before I actually think that it wasn't a fluke and I didn't fall backwards into money. And again, totally changed my life. And so really cool. And to be here, like, doing a deal together with Jay and raising capital through this fund to invest in this project and hopefully, be a little bit of like wind behind their sails to get this thing done with all of us. So it's really cool. Like, to have a mentor of mine, and we've been connected on Facebook, had the opportunity to meet in person and spend some time together down in Tampa. And I just say that to tell you, if I am a mentor of yours, then Jay is like just like one step up on the family tree that mentored me from afar through those books that he wrote, and then everything else that he's done since. I still read every single thing that he posts on Facebook about the economy, the market. Really gives me great insights to pass down to you. So a lot of what you guys hear from me, he's part of that, and me just being kind of a filter of what I share to you. So Jay, I'm grateful that you're here. I want to make sure everybody knows who's about to take the stage, because you've been a blessing to me and my family. And honestly, like most of the people that are on here that are in our mastermind at Seven Figure Flipping don't even know that my success wouldn't have even happened, or I wouldn't be where I'm at without you.
Well, that's very kind. I appreciate that. That super nice introduction. Thank you. Thank you, everybody, for coming. I'm going to start by apologizing. You never start a presentation by apologizing, but I've had the flu for 2 weeks, and so I'm feeling a lot better. But if my voice cracks or if I have to stop for a sip of water, I apologize in advance. So a little bit, that was a great introduction, a little bit, tiny bit more about me. I am a former engineer. I spent most of my career pre-real estate in Silicon Valley. I managed a large technical team for Microsoft. 2008, my wife and I decided to get married. She was doing the tech thing also, and it just wasn't conducive to a good work-life balance. So we left the tech world, started in real estate. Over the last, 18 years, I've done about 250 million in real estate. did a lot in single family for a decade. And then for the last 8 years or so, I've been focused on multifamily. I got into multifamily because I was looking for a place to put my own capital. Not necessarily, wasn't necessarily looking to raise money from other people, though I do like doing larger deals. And so working with other investors has always allowed me to do those larger deals, but also allowed me to place my own capital in deals. To do the deals that I really like and really want to do. So today I'm going to talk a little bit about our upcoming deal. I will mention that we haven't done a large deal like this since 2022, not for lack of looking. It's been a tough time in multifamily the last couple of years. We've made a lot of offers, but we're just not willing to overpay for deals. We haven't seen anything that we were really excited about until this project. And so we haven't done a lot of deals over the last couple of years, and I'm really excited about this one, and I'm really glad that we decided to pursue this one about a year and a half ago, and I'll tell you a little bit about the history in just a moment. So this is Railroad Lofts. Let me also point out that if you guys come into this deal, you are technically investing through Bill and Adam's fund, but I do want to make it clear that you're investing in our deal, and as such, I consider you one of my investors, and you will always have access to me. If you have questions, obviously Bill and Adam can probably answer them, but if you ever want to talk to me, or if you have questions for me, or you just would rather come to me, you're always welcome to do that. Okay, so let's jump in. Quick disclaimer. My lawyer wrote this, so I'll skim it. But basically, this is a business plan for our investment. It has some privileged and confidential information. Please don't use it to compete against us or distribute it publicly without our permission. And then our financial disclaimer, basically, everything that I'm about to talk about is projections. It's our best analysis and underwriting of what we expect to happen on this deal, but we can't guarantee anything. And just because we've been successful in the past doesn't necessarily mean we're going to be successful in the future. So do your own due diligence, ask lots of questions. And again, you're always welcome to talk to me. We'll talk about that at the end of the presentation. Okay, let's jump in. Executive summary. So what we are building with this project, or what we're doing with this project, is we're building a 351 unit multifamily apartment complex. This is a Class A development. We're just southwest actually of the Dallas-Fort Worth Metroplex, in the Dallas-Fort Worth metro area. We'll go into more detail on all of this, but this is part of a larger master plan community. We're developing the multifamily portion of a large master plan community that's also going to have residential, shopping, office. It's even going to have a medical center and a hotel. We have a very highly experienced developer partner and general contractor. I'll talk all about our construction team in just a moment. For those who have invested in new construction before, this is something that you'll find that's a little bit different than most new construction projects out there. This is a 3-year investment. A lot of new construction projects out there are 5, 6, 7, 10-year development projects where you can expect longer term cash flow. We have a lot of investors who they're not necessarily interested in long-term cash flow. They're interested in generating relatively large returns very quickly, getting into a deal and getting out of a deal. A lot of our investors are younger. A lot of our investors are real estate investors themselves, and they like the idea of being able to invest in something, get their money and their profits back in a couple years, and then find the next great deal. So what we've done on this deal is, instead of doing that traditional build, hold, generate long-term cash flow, we're going to build, we're going to stabilize, and then we're going to resell in year 3, or at least that's the plan as of now. I'll talk about contingency if the market or something else doesn't allow it. In terms of returns, again, we'll talk about this in more detail. Projected 22% average annual return. Expect cash flow starting in year 2. There won't be any cash flow in year 1, again, as this is a large development project, 351 units, but expect that you'll start seeing cash flow in year 2 as we're doing a phased development. I'll talk a little bit about this, but we're going to be bringing units online as we're finishing out the rest of the complex. We'll be getting COs for individual buildings, so there will be cash flow before the project's complete. Additionally, there's going to be significant tax benefits. The way the tax benefits work, and I'm happy to talk in more detail. I also recommend anybody that is looking at investing for tax benefits on this deal, talk to a licensed CPA or tax advisor. But the way tax benefits work on new construction is that those tax benefits don't actually get passed through until after units come online and we're starting to collect rent. That will not be in 2026, so there won't be tax benefits in 2026, but we will have units coming online in 2027, and we suspect that there's going to be significant tax benefits in 2027 and 2028. Minimum $50,000 investment on this deal, and you must be an accredited investor. If anybody has questions on what that means, happy to talk about that and dig into that a little bit as well. Okay, so that's the high level. Let's jump into the details around all of this, and we will be taking questions at the end. And you're always welcome again to reach out to any of the three of us after the webinar is done if you have additional questions or want to talk in more detail. Let's talk a little bit about the team, because this should be the single most important question that you're asking. A lot of important things whenever you're investing passively in a deal, but as far as I'm concerned, and I've invested in about 6,000 units passively with other operators, and this is by far the single most important question that I ask, or the single most important area where I do due diligence before I invest in anybody else's deal, is who's the team and why should I trust that team? So on a development project like this, we typically have two sides to the team. We have one side of the team that's responsible for essentially putting the deal together. They're responsible for underwriting. They're responsible for the financial analysis, the due diligence, raising capital, legal, compliance, accounting, making sure that the business model makes sense and all the numbers make sense. Then once the property is leased up, or once the property is completed, they're responsible for getting that property leased up, working with a great broker to get it listed on the market and get it sold. And so that's going to be my partner, Ashley, and I. We are partners at Bar Down Investments. We've been partners for about 8 years now. We've gone full cycle on several projects. Again, we haven't done anything since 2022, but all of our projects have either gone full cycle or currently operating well. Happy to go into our portfolio in more detail if anybody has any questions. But suffice it to say that Ashley and I and our team are going to be responsible for the business side of the deal, the asset side of the deal, and leading the deal. Then, probably just as if not more important on a development deal like this, is the development and construction side of our team. Number one, we have a developer partner. His name's Kerry Clark. What I mean by developer partner is that he is literally a partner with Ashley and myself. He has significant equity in the deal. He has a long history of commercial and multifamily development. He lives in Dallas, so he's our boots on the ground. He will be our day-to-day development lead on the project. He will be there overseeing and making sure that the contractors are doing what they're supposed to do, making sure that we're on budget, on schedule, etc. Secondary, we have what's called an owner's representative. So this is a term that's commonly used in the industry. And typically this is somebody who is a consultant who has a long history of successful development of the type that we're doing or that is being done. In this case, again, large multifamily. Mark Lindley is somebody we've worked with for about 8 years. He runs a company called J-Mark Development. He's been in the business about 37 years. He's delivered over $1 billion in multifamily and student housing for some of the largest developers in the country. A few years ago, he went off on his own and now is a consultant and acts as an owner's representative, which means he's basically our liaison between our development team, our lender, our GC, our vendor partners. Basically, he's the guy that has tons of experience building this exact type of deal and will play the third party that kind of pulls everybody together and makes sure everything gets done. At the end of the day, he works for us. He's a consultant. He gets paid a fee, but to align interests, we've made sure that Mark has an equity stake in the deal. So Mark has a vested interest in this deal going well. He's not just getting paid a fee. And then probably the most important piece of the development side of the stack is our general contractor. This is the company that hires the labor, procures materials, makes sure that things are going smoothly day to day. They do all the scheduling, they do all of the payments, and they're the ones that actually build the project. And for this project, we're using a company called Construction Enterprises. CEI is probably one of the largest multifamily developers in the country. They've been around for 47 years. They've delivered over 30,000 multifamily units. They've delivered over $5 billion in new construction. They are considered one of the leading multifamily developers in the country. They're actually located in Tennessee, probably maybe not too far from Bill, and they build around the country. Bill, are you in Tennessee? That's what I thought. Okay. So if anybody has any questions about our team, our portfolio, our track record, happy to delve into that in more detail. I don't want to get hung up on that, but always happy to talk about that if anybody has questions there. And then since most people have the most questions around who our GC is, because that's, again, probably one of the most important pieces of this project, you are more than welcome to jump onto their website, constructionenterprises.com, where they list out literally their 47 years worth of portfolio and history, and you can see the projects that they've done, where they've done those projects, and learn more about them. Okay, so that's the team. Let's talk a little bit about the location. This deal, as Bill mentioned, is in Dallas, in the Dallas-Fort Worth metro area. Specifically, we are in the southwest corner of Dallas. One of the reasons we love Dallas, one of the reasons that we're even pursuing this deal, is that Dallas is one of the fastest growing metros in the country. It's been the largest or fastest growing metro for the last 2 years, and as of what I've seen, they're either number 1 or number 2 on the list for 2026. The one area of Dallas that hasn't seen as much growth over the last couple of years is the southwest corner. One of the reasons why we love this project, because it's in the southwest corner and it's on the path of progress. I'll talk a lot more about that in just a moment. But one of the reasons we love this project is because it's path of progress, and it's the single part of Dallas that hasn't seen significant growth yet, and is likely to see significant growth in the coming couple years for the reasons I'm about to discuss. So number one, we put this property, just a little bit of history, we put this property, or at least this piece of land, under contract June of 2024. So over a year and a half ago. We did an option contract, meaning we basically had the rights to buy the land without buying it outright. The reason we didn't buy it outright was because this was on the path of progress. We wanted to verify that we could actually expect to see growth in this part of Dallas over the next couple of years, and that growth would coincide with our lease up in year 2 and year 3. Basically, we wanted to make sure that there was going to be enough demand for us to be able to achieve our business plan in this part of Dallas. Well, about 4 months after we got the option contract, we were very pleasantly surprised that Amazon announced that they were going to be building an operations center with 1,100 employees, literally a half mile from us. That's our development there. You can see that Amazon over the last 12 months or so has started development. They're actually a good bit further along than what you see in that picture. That picture was from, I think, last May or June. They're almost ready to open that facility, but that's 1,100 employees that will drive supply in our area for apartment rent or apartment tenants. Additionally, the city, the state, when Amazon came in, I'm not sure if this was negotiated with Amazon as part of the deal, but about 6 months after Amazon announced that they would be building, the city announced that there was going to be a $250 million investment in expanding the main thoroughfare from Fort Worth down to our city, Cleburne, Texas. And you can see on the left-hand side that red arrow or that red line. That's basically the major thoroughfare from Fort Worth down to Cleburne. And if you were to drive that today, you would see that there is significant expansion in that road right now. $250 million is being put into that. So clearly the city, the state believes that there's going to be significant growth into this area as well. A couple months ago, my partner Carrie went to the Chamber of Commerce to see what other growth was expected in the area. As of, and I think this was September, there were 18 other pieces of property around Amazon that had been purchased that are going to be developed by companies that will be supporting Amazon. So we don't know exactly how many employees that is, but we expect that there's going to be significant additional employment in this area over the next 2 to 3 years as those companies build their warehouses, their facilities, their whatever they're building, and start staffing up. And then finally, for any sports fans, baseball fans. Literally right next to our property is the Cleburne Railroaders baseball stadium. This is a $25 million, a minor league team, $25 million stadium that was just finished in 2020 and draws some pretty large crowds from around the Dallas-Fort Worth area. And so that bodes well for growth as well. I'll talk more about market supply and demand in the next few slides, but long story short, we were very pleasantly surprised with all of these developments since we put the land under option contract. Once this happened, we quickly decided to make the purchase and followed through before the developer or the master plan community developer found another buyer. So we now own the land, and I'll talk about that as well in a few minutes. Little bit about the larger plan development. So again, we're Railroad Lofts. We're this multifamily 351 unit complex in the middle of a much larger master plan community that's going to contain build-to-rent single family, which is pretty much already built, some office, townhomes, office and retail, medical, hotel, a bunch of retail and restaurants. All of those are currently in the process of being permitted and should come online, hopefully right around the time that we deliver in 2027, 2028. But this is a large master plan community. This was developed by a company called, I'm forgetting the name of the company, but they're a large developer that goes around Texas. They buy large tracts of land, they subdivide them, they entitle them, and then they sell them off as master plan communities. And we bought the multifamily portion of this master plan community that we will be developing, Railroad Lofts. In terms of what the property is going to look like, happy to go into a lot more information if anybody cares offline, but basically it's going to be 11 tenanted multifamily buildings. In the center, there'll be a large clubhouse, lounge, fitness center with our leasing office. There'll be a very large resort style community pool for the tenants. We'll have garages, carports, electric charging stations, and then all of our properties, one of the things we take pride in, and we've actually won awards, is being very pet friendly. And this property would be no different. We will accept pets, and we're going to have a large dog park as part of the amenities as well. In terms of unit mix, we do expect that a lot of our tenants are going to be single professionals. Again, this was reinforced when Amazon started building across the street from us. And so of the 351 units, nearly 2/3 are going to be the 1 bedroom, 1 bath. Most of the additional are going to be 2 bedroom, 2 bath, and then we'll have a few 3 bedroom, 2 bath in the mix for the larger families. This is pretty much in line with the rest of the properties around in this property's area. In terms of exact comps, one of the nice things we like here is that there are no other Class A developments coming online before we release. The last property that got developed in this area was 2024. Most likely the reason for that is that interest rates spiked in 2022, so people stopped buying land in 2022, 2023. And because it takes a couple years to build these properties, basically what we saw was those folks who bought in 2020, 2021, beginning of 2022, finished building by 2024, but no new development went up, which means that there's demand that's building up, but not a lot of new supply that's coming online between now and when we release in 2027, 2028. And if you look in the bottom right corner, you'll see that there's been no new deliveries in the last 12 months. The last delivery was Chaparral at Ranch Homes, built in 2024. And then that under construction 221 units is actually that build to rent community that I mentioned right here, that's part of our master plan community. So these are single family units that are coming online. We don't consider them to be direct comps. We don't consider them to be direct competition. People that move into build to rent are probably looking for something a little bit different, generally a little bit more expensive than multifamily. But we take this directly from the third-party market study that was done on our behalf by our lender, and they did include that build-to-rent as part of the supply that's coming online. But for the most part, as you can see, we're pretty much the only game in town when it comes to Class A multifamily for the next few years. In terms of exact supply and demand, again, this comes from our third-party market study report that was commissioned by our lender. But basically, all the new units that are expected to come online over the next couple of years are the properties that were developed in 2022, 2023, and 2024 that are in the process of leasing up. A lot of them are fully leased, but there are a few of them that are not fully leased. And those are the units that will generate supply over the next couple of years as they continue to come online. This Avila Railhead, that is that build-to-rent community that I talked about, and that accounts for about 20% of the units that are coming online. In terms of demand, and this has changed a little bit. We have not commissioned a new market study because the lender was happy with these numbers, but because of the employment growth from Amazon and the other companies in the area, I suspect that the anticipated demand, both from household and employment growth, is going to go up. But based on the numbers we got in our third-party market survey earlier in the year, essentially over the next 3 years, by the time we release, we expect several hundred units of additional demand over supply that's being released, and that includes our property. So over and above our property, there's still several hundred units of demand over and above the supply that will be available. So that's great for both our occupancy projections and in terms of our rent projections. That should put some upward pressure on rents anytime you see more demand than you see supply. In terms of our timeline and our schedule, again, we put this property under lease option back in 2024. At the time, we were completing due diligence. We did our environmental survey. We did some geotech. We did that third-party market survey. We basically put about $600,000 of our own capital into this deal before we decided to move forward. So we are very well vested in this deal. We did our architecture. We did our design. And then in 2025, we worked with HUD on starting the loan process. So I'll talk a little bit about the loan in a few moments, but long story short, for the type of loan that we're doing, it's probably the single best multifamily loan product on the market. And it basically brings HUD in as not just a lender of ours, but a partner of ours. It's a it's a loan with very, very favorable terms, but HUD takes about 15 months to get through the process. It's actually been closer to 17 for us because of the government shutdown. But they basically come in and they want to partner with us, and they replicate all of our due diligence. They do the market studies for us, and they basically will not let us move forward unless this is a deal that they would do themselves. Middle of the year, back in July, we got preliminary HUD approval. And once we got preliminary HUD approval, we kind of used that as our trigger to purchase the land. We knew we'd be moving forward on the deal because we had HUD's basically buy-in that they thought this was a great deal. So in July of 2025, we raised $5 million to purchase the land. Land was purchased on August 1st, so we do own the land. Since then, we've completed our design. We got permits last week, so we were granted permits last week. Obviously, we can't start to move forward on development until we get our loan approval. But once we have loan approval and close the loan, we will start development. So again, we got permits last week. We expect HUD loan approval actually today. So we're very excited, and we're kind of sitting on the edge of our seat waiting. HUD has, they do basically loan committees where they vote on approving these types of loans. Last week was the regional committee. The regional committee voted to approve our loan. When it goes to the national committee, and the national committee is voting this afternoon. So hopefully we'll have verbal approval on our loan this afternoon. We should have written approval by the end of the week. And generally it's about 60 days from that where we close the loan. So we expect to close this loan mid-March-ish, mid to late March, and then we will start construction immediately after that. Given that, we will officially be moving forward with this raise. We've already started raising capital, but the thing that will trigger the official raise and starting to collect capital will be this HUD loan approval that we received today. And we are raising about 8.3 in additional funds, so total of about 13.3 million in total funds for this project. 2027, we expect about a year after construction starts, Q1, Q2 of 2027, we'll start delivering units. We'll start leasing up those units. At the same time, we're going to continue construction. That won't be the end of construction. Those will be the first units delivered. We do expect to begin cash distributions to investors once we start lease up, probably middle of 2027, Q2, Q3 of 2027. 2028, we expect to complete construction. We'll do our final lease up. We'll spend about 6 months stabilizing the property, and then we'll work with the broker to get it listed and hopefully sold in Q4 of 2028 or Q1 of 2029. We're expecting this to be hopefully less than a 3-year project, or at most a 3-year project. In terms of the money on this deal, so how much money do we need to do the deal, and where is that money coming from, and what are we going to be doing with that money? Again, I mentioned that it's a HUD loan. Specifically, it's called a 221D4 loan. I'll probably refer to it as a D4 from now on. That's kind of the industry terminology for this type of loan. But HUD will be loaning us about $59 million. We'll be bringing an additional $13.3 million in investor and our equity, including Bill's investment, Adam's investment, my investment, which I'll talk about, my partner's investment, for a total project cost of about $72.5 million. Of that 72.5, we purchased the land for about 3.6. We have gotten an appraisal since we purchased the land. That's gone up about 10 to 15% since we purchased the land, which is another great sign that we are poised to see growth in that area. There'll be about 8.3 million in escrows, lender holding, closing costs, fees that I'll talk about in a minute. We'll have about 7.3 million in soft costs. The partners already have spent already about 1.2 million in soft costs, things like again, permitting, design, architecture fees, engineering fees, studies, geotech studies, soil studies, things like that. And then the actual vertical cost, basically building the property, is going to be about 53.1 million. So that's where the $72.5 million will go. In terms of fees at the project level, and this is not fees from the fund. This is not reflective of the fees that you'll get charged investing in this deal through the fund. This is specifically at the project level. These are all pretty standard fees for a project like this. 1% for construction management that will go to our GC. This third-party real estate commission, that's the one fee that's not typical. Our partner, Carrie, found the land back in June of 2024. He's also a real estate broker, so he did take a 2% commission on the purchase of the land. That was back in July. This is the one fee that's not typical, but because he's a broker and he found the deal, we did agree to let him take a 2% commission on the land purchase. And then standard 3% developer fee, which is split between the GC, the owner's representative, the developer partner, and the rest of the team, as basically the equivalent of an acquisition fee, but it's called a developer fee on a deal like this. And then ongoing fees, there'll be a capital transaction fee. 1% of the sale price will be a fee at the sale of the property, assuming assuming the deal is successful and makes money, which we all expect that it will. And then an asset management fee of 2% of the gross effective income per year. Again, there'll be no income the first year, so there'll be no asset management fee the first year. There'll be a little bit of income the second year, so that'll be small. And then potentially third year, there'll be some significant income, and we could see a larger asset management fee, but that's specifically to compensate the team that focuses on lease up and management. Okay. Quick about our debt structure. Again, I mentioned this is a HUD 221D4 loan. If you know anything about HUD loans or loans in general, or even multifamily loans, this one might be a little surprising. Basically, what HUD is willing to lend is up to 85% loan to cost. We're a little bit below that. I think we're 82 or 83%, but they're willing to go up to 85%. It is a fixed rate loan for 40 years. And it's fully amortized, which means the loan gets taken out today, and in theory, we could keep this loan and this property for the next 40 years at a fixed rate. The first up to 3 years of that is interest only. When I say up to 3 years, it's either 3 years or when the project's completed. We expect the project to be completed after 2 years. So it'll be 2 years of interest only, and then it will go to a 40-year fully amortized loan. And this loan is fully assumable, which means that when we want to sell in 3 years, when the new buyer comes along and wants to buy this loan, they can take over the loan exactly as we had it. They will be 3 years into a 40-year loan. They will buy the property with the exact same terms, 40 years, same fixed interest rate. If they choose to sell the property 2, 3, 5 years down the road, their new buyer will get the same terms for the remainder of the 40 years. Buyer after that will get the same terms for the next 40 years. So we don't have to worry about interest rate risk or interest rates going up on this deal, simply because we do have a fixed rate for 40 years and that loan is fully assumable. Other thing worth mentioning, I kind of touched on this with these loans. They're amazing loans, but they take a long time to originate. Again, we've been working for about 17 months right now, and HUD is very integral in the entire process. This is bad from the sense that they have a lot of requirements. It cost us a lot of money to kind of do everything that they needed us and wanted us to do, but at the same time, HUD does very few of these loans. They will only do 2 loans within a submarket, meaning there is no other property right now that has this type of loan in this market. But at most, HUD would only do 1 other because they don't want to compete with themselves on these types of loans. And HUD basically will not do this deal unless they consider it to be a home run. For lack of a better term. So just the fact that we expect HUD approval on this loan after 17 months today is a good indication that all of the due diligence that we did, all of the findings in our business plan all make sense and are all aligned with reality. Okay, some underwriting safeguards. So what we've done to be conservative on this deal. Let me start with the thing that we are not conservative about, because every operator says, hey, I'm conservative in everything and I'm never going to be aggressive and you never have to worry. There is one part of this deal that I'm going to say we've been a little bit more aggressive than anything else, and that's on the schedule. So building, stabilizing, and selling in 3 years is absolutely realistic, but it is probably a little bit more aggressive than most deals accomplish. So if there's one area of this project that I would say we could go over, or we haven't been as conservative as possible, it would be that 3-year schedule, especially given the current labor situation in the country. So I'm sure everybody's familiar with what's going on with immigration. I'm absolutely not going to get political, but I will say that there is concern that there could be some labor shortages or some labor slowdowns over the next couple of years, given current immigration status. And our 3-year schedule kind of is predicated on this deal kind of going as planned, going pretty smoothly. So if we do see disruptions in the labor market, if we do see other surprises, if we see bad weather for months at a time, it is that schedule that could get bumped a little bit. We are, I'd say, cautiously optimistic that we can hit that 3 years. But if you were to ask me the one area of the project where we've been less conservative than other areas, it's probably that schedule. And if you need your money back 3 years to the day, if you can't handle going a few months over or 6 months over 3 years, probably not the deal for you. I don't want anybody to get into the deal and then be disappointed when we don't close this property exactly at 3 years, even though that is the business plan and that is our expectations as of today. On the financial side, I do believe we've been a good bit conservative. Again, we are all investing in this deal. Bill's putting his own money in the deal. Adam's putting his own money in the deal. My partners and I always invest minimum of 5% of the total equity of the deal. 5% of that 13 million. We'll probably get closer to 10%. We're normally closer to 10, but guaranteed 5%. And people ask, well, what determines how much we're going to invest? It's basically how much investor demand we have. If we have so many investors clamoring to get into the deal, we'll take the 5% we carved out. If there's room at the end where investors haven't taken up all of the deal, we'll buy the rest ourselves happily. So from a financial perspective, some of the underwriting safeguards that we put in place, one, if you've been invested in multifamily the last couple of years, you know that one of the things that's really hurt deals, killed some deals, has been the debt risk. So number one, basically interest rates going up. we have no interest rate risk on this loan, or we don't have to worry about interest rates going up simply because we're going to have a fixed rate for the next 40 years. We don't have a refinance risk. Again, 40 years, we don't have to refinance out of this loan. It's not even a construction to perm loan, which means it doesn't convert from construction to perm. It's all one loan. There's nothing that triggers any change in the loan at any point. Once we get approval for it and close the loan, there are no other requirements other than we continue to pay our debt service. And then finally, we won't be deploying any funds. You won't be committed to this deal unless and until we actually close the loan. This was more of a risk for our first round investors last July. They basically invested in the deal before we had formal approval on the loan. Again, we expect formal approval today, and so nobody that's investing in this round will have any risk around the loan not closing, because we wouldn't do this deal if this loan doesn't close. On the budget side, we have about $5.2 million at least in lender and cash reserves. That's about 10% of the total hard cost budget on the project. $1 million of that is a 2% builder's overhead. Basically, we asked the builder to add 2% to every line item in the hard cost budget. Basically, take everything that we're paying, add 2% right off the top to ensure that if prices go up, the first 2%, it doesn't impact the budget whatsoever. On top of that, we have another $4.2 million that the lender has required us to put into both their escrow and our escrow. Basically, $1.9 million that they're going to hold, 2.3-ish million that we're going to hold. They're actually talking about maybe increasing that by another $1 million, just given the current environment, interest rate environment. So it could be as high as $5.2 million that we keep in reserves. That money will be used in case there's surprises, overages. One of the nice things about that is we have not factored that 4.2 million, or if it's 5.2 million, even better, we've not factored that into the return projections that you're about to see, which means we're assuming that every penny of that $4.2 million is going to get spent. We're either going to go over budget, we're going to have a surprise or a lot of surprises, and that entire 4.2 million is going to get spent. If any of that 4.2 doesn't get spent, and best case, none of it gets spent, that will be accretive to returns, meaning that will boost your returns, because the return structure that you're going to see assumes every last penny of those cash reserves go away to either overages or surprises. And then on the exit, we've tried to safeguard the exit as much as possible. Current cap rate in that area, according to the brokers that we've spoken with, according to HUD, according to our third-party market study company, is that Class A multifamily is trading at about 5% right now. Cap rate, we're assuming a 5.5% exit cap rate. So we've expanded that cap rate about 0.5%, which means we're assuming a lower value in 3 years than what we think we would get today if the property were done today. I often get asked the question, what happens if you can't sell? What if the market collapses? What if cap rates go up and you can't hit your targets and you choose not to sell for any reason? Again, we have a 40-year loan, fixed interest rate, and I'll talk a little bit about the yield to cost, which is basically how much cash flow this property will generate. But we do expect the property to generate a decent amount of cash flow, more than 6% a year, starting in year 1 or year 3 when we deliver the project, and increasing from there. So if for some reason we couldn't sell in year 3, or if for some reason we find that it's not favorable to sell in year 3, there's nothing stopping us from our projections to hold this property for 4 years, 5 years, 10 years, or 40 years. Again, we're not going to hold this property for 10 years or 40 years, but hopefully it'll make you feel a little bit better to know that this property would support a hold long term. And again, assumable loan, our future buyer has no rate risk. Their future buyer has no rate risk. No future buyer for the next 40 years has to worry about interest rates going up. Okay, projected returns. These are projected returns at the project level, which Bill will talk about in a minute, is essentially equivalent to the project returns. Bill and Adam have structured their fund in such a way that you should receive as good, if not better, returns by investing in the fund as you would investing directly with us. The fund gets some benefits for aggregating a lot of capital and bringing it all all to us at once. The fund pays, I'm sorry, our project pays some benefits to larger funds that come in, and so your projections are boosted coming into the fund because the fund has some benefits from the project. But average annual returns are somewhere between 22-23%. I know people like an exact number there. We do have some exact numbers, but because we have different classes of shares at the project level and we don't know exactly how much money is going to come into each class until the end of the raise, we can't come up with a too significant figure return projection, but it's somewhere around 22-23% with an equity multiple of a 1.6. Our yield on cost, again, is about 6.74, which for a development project basically translates to a cash on cash return of about just under 7% the year we deliver, which means this property will be cash flow positive over and above our preferred return starting in year one. And then if you care about some of our other exit metrics, they are there. These projections do assume a sale in Q4 of 2028, Q1 of 2029, so a 3-year hold. Okay, and then I always like to include this chart here. This is a sensitivity analysis. Basically, what this does is it gives you an idea of what happens if some of our biggest assumptions are wrong. And the two biggest assumptions anytime you're selling or repositioning or building a multifamily or commercial asset is your NOI, basically the income the property is generating at sale, and your exit cap rate, which is basically the multiple that the property receives from the buyer at sale. And what we like to do with the sensitivity analysis is we say, what happens if we're not generating as much income as we projected, or we're generating more income than we projected? What happens if the exit cap rate is higher than we thought, or lower than we thought? And so the way you read this chart is this 23.88% number. This is our best projection of the exact average annual return you should expect given our exact expected income and our exact expected cap rate. As you go further to the right, this is if we're making more income than we expected. As you go to the left, this is making less income than we expected. As you go up, that's a lower cap rate, which means a higher resale value. And as you go down, that's a higher exit cap rate or lower resale value. So this gives you an idea of if we miss our income and our cap rate projections, how does that impact returns? Obviously, if our exit cap rate is lower, which is better, and our income is higher, returns can go up significantly. Conversely, if our net operating income and or our cap rate is off to the other direction, our income is less, our cap rate is higher, we're going to see worse returns. The thing I like about this chart is it kind of gives you a reasonable idea of how bad things would have to go wrong before this project lost money for investors. In this case, if we saw a 10% deviation in income, basically 10% less income than we expected, and a cap rate of a half point higher than what we're expecting, the project starts to lose money. Likewise, even if we hit our income, but we see a cap rate of a point higher, we would lose money there. Basically, these orange or these red squares down here are the situations where the project loses money. Obviously, our goal is to go up and to the right, not down and to the left. But this should give you a good idea of what happens if we're wrong, again, either on income or cap rate, those two big numbers that contribute to the sale, and how that would affect your returns. And you should be able to access this deck in this presentation afterwards if you want to look at this in more detail. Okay. Sorry, I'm a little bit long-winded there. I apologize, Bill. I'm going to let you jump back in and talk a little bit about the fund and the structure.
Yeah, thanks, Jay. So before I go into this, a couple things, I took some notes, some things that I really love about this project. I love, number one, it's 3 years. I got a lot of you that are coming to me saying, hey, your 7 or 10 year project, like Jay said, just a little bit too long for me to kind of tie up my capital. This is somewhere really in that sweet spot with very similar, if not higher projected annual returns, average annual return of as good or higher than the other deals that I've had that have been longer timeline. And when you see that multiple, a lot of you might be expecting and have seen historically like a 2 or a 2.2 on most of our deals. Well, keep in mind that was in 7 years. 1.6 plus is in 3 years, makes it even better. The other one is I think the minimum here is very reasonable at $50,000. Usually you see maybe $100 or even $200,000 minimum on projects like this potentially. And that's the beauty that we have of what we're about to talk about is as a larger fund, I can take a smaller minimum because we're going to invest as a fund. The third one is the partner that's building this project. I love their experience, what they bring to the table, and not just the builder, but also Jay bringing in a consultant effectively to also support that. And I'm building a huge project in Boise right now, and I can tell you right now, the consultant for me is it's 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 so valuable to have that of somebody who's built, dozens and dozens and dozens of these. Um, and then the next one is the loan product. Like it actually wasn't until I listened to this presentation in depth that Jay just went into of how amazing this HUD loan is. For those of you guys that have been in the multifamily space or have invested with me in the past, and you've seen the headlines of what people are going through right now with bridge financing and things like that. The loan product has been the lever that's been the difference between success and less success or even failure in recent years. So those are a couple things that I wrote down. And then I love the fund model that I'm about to talk about because, like Jay said, we actually have some law of scale where when we invest together in the project, we can actually get slightly boosted returns in certain areas. And a smaller investor can actually get the return from the bigger fund. So that's kind of where it takes me to this. You got the operators and the general partners that Jay talked about. And a difference between probably a webinar that you've been on before is I'm actually not a general partner in this deal. What I am going to be doing is Adam and I will be running the fund that we invest into this project with. Okay. So Adam and I will be running and managing that fund, which is where your money will go into, which is where we will be deploying the capital in. We'll be doing all of the K1s, all of the tax returns. You'll still be coming to me with questions about the project, but this is very transparent where a lot of times you might have been on one of these webinars where me and Adam and Jay are talking about the deal, but I have nothing to do with the deal. I'm getting an email from Jay and then I'm sending it back to you. So a lot of people are raising capital that way. We just want to be very transparent about how we're doing business. So
And can I just point out
yeah,
that if that sounds a little different than what you've heard before, it's because that's the legal way to do it. And there's been a lot of I don't want to accuse anybody, and I know people don't do this on purpose, but there are a lot of really detailed and onerous SEC requirements around raising capital, what's legal, what's not legal. And when folks do things that are kind of a little bit gray area-ish, it puts the entire deal at risk. We were very, very careful about doing everything the legal way, which is why we actually structured this deal in a way to make it advantageous for funds like this to come in and partner with us as a limited partner, as opposed to doing it, let's call it illegally, on the other side. So yeah, we do take pride, the three of us here, we do take pride in the fact that we're doing this the right way.
yeah, Jay's being really nice. There are a lot of people out there doing it illegally. I'll just call them
Yeah.
out right now. I'm not gonna say their names, but pretty much everybody.
Yeah.
And then, so what you see here is effectively we have the limited partners that are coming in that Jay knows, and then we built a fund of funds model. So it's basically a fund that's going to invest in this project. It's a 506c syndication. It's got its own documents. It's got its own paperwork. We're going to have all the stuff that we normally do when you guys invest with me, but it'll be 7FF Railroad Lofts Fund. We'll be capturing it, basically aggregating all of that capital and then investing as a limited partner into the project. So, and I'll be investing right alongside of you. So what we're doing is, when we aggregate enough capital, we can actually get some law of scale. So, Jay, if you want to go to the next slide for me. And this is a structure of the fund. So effectively, this is our and we have waterfall at the top there, but you can just kind of like delete that from your mind. So we have a $50,000 plus investment. So anywhere between 50K and some people will say, hey, what's the maximum? The maximum is just going to be a level at which we have room in the deal. We have a target of 1 million plus. Would love to raise, 2-3 million. I think, Jay, do you know how much is available right now of that 13 million?
So of the 13 million, I think we're down to about 4.
Okay, so we have the ability to go up to 4. So I know some of the people on here are larger investors of mine, and so if you guys want to make a larger investment, just reach out and we'll just let you know based on the timing and when you make your commitment what's available and left. So preferred return is 6%, and what that means, we've talked about this in the past, right, as a team. So preferred return is basically, if you see hurdle one, is up to 100%. So you're basically accruing that 6% per year, and that gets paid out first before any equity split from LP to GP. So that preferred return, so the bank gets paid, preferred return gets paid, and then LP GP split. And so after that 6%, then it's an 80-20 split. So 6% preferred return, 80-20 split above and beyond the 6%.
And just to make it clear, 80-20 in favor of investors.
Yeah.
Not
Thank you. Yeah. Yeah. So 80% coming back to the investors. This, I most of the questions I get are on the fees. So I wanted Jay to show some of the fees on the front for the deal, and then I want to show you the fees for the fund. So what we're building, and just this fund participation fee. Usually, guys see 5% and go, "What?" Like you're used to an acquisition fee, which is the amount of purchase price or all-in capital that's raised. It's a percentage of that, right? So this participation fee is 5% of what we raise. So if it's $1 million or $2 million, it would be 5% of that, not 5% of the whole project. Okay. So I want to make sure that you guys aren't thinking that. And what this is for is for us to set up the fund. There's some expenses for us to set up the fund. It costs money to do that and management and things like that. So it's basically for us to build the fund, for us to participate, the project pays a percentage to the fund. And then after that, there's just a $3,000 per year fixed fee for us to do a lot of the accounting, tax prep, things like that to get your K1s and everything out to you, especially as we wrap up the project. So a little bit of administrative costs, but no management fee, none of that, not a percentage, none of that stuff on top of that. So very low front end cost for us to set up the fund and run the fund. Next step, if you guys are interested, I will have a page. I have the page. I just have to tweak a couple things on it. So there'll be a landing page that you guys go to that has all the paperwork, just like we've always done. You can DocuSign in there and all that stuff. But right now, if you guys just shoot an email to me and Adam, just CC us. If you're, one of Adam's investors, just drop me on the CC. Same with Adam. That way we can answer any questions. And then just make your soft commitment. If you say, "Hey, I'm in for 100K or I'm in for 200K," just shoot me an email and we'll include that. And then I'd say probably be a day or two before I get the page set up where you can make your soft commitment online. It's a new fund, it's a new structure, it's a new deal. So I'm just finalizing all of that. We wanted to launch it and get it out to you as soon as possible though. And then you can complete the paperwork once we have it ready. I would say the paperwork will be ready in about a week. So we have to get all the PPM and all the documents set up right now. And then your accreditation proof. So proof of being a accredited investor. If you already have a letter from a CPA and an attorney or something like that, you can just shoot it over to us with the email. And then we'll upload it into the portal. And if not, we have some online systems or different ways that we can help out with getting you guys proof of accreditation. And then we're looking to have funds. This is usually a question I get all the time by February 20th. Okay. So Jay talked about the timeline a little bit. Obviously, the earlier we get the funds in, the better, just so we know that they're there. But if you guys have a timeline challenge or something like that, included in the email that you reach out to us with. So Bill at blackjackre.com, Adam at blackjackre.com. And then you got Jay Scott's email here. If you guys want to ask him any questions, Jay, you can take that. And then if you got, while Jay's talking here, if you guys can drop any questions that you might have in the chat. I know we're a little bit over an hour here already. So if you have to bounce, that's fine. But if you can drop some questions in the chat or anything that you have, I'll address them right after Jay gets done.
And again, if anybody has any more detailed questions, I'm not a sales guy. I'm an engineer. I'm not here to sell you, just give you information. So if you want more just underwriting questions, if you have questions about the property, what we're building, what the budget looks like I'm an open book. So don't hesitate if there's information you need to feel comfortable moving forward, schedule some time with me. And as I mentioned earlier, if you're an investor in this deal, you're an investor with me, and I'm always available. All of my investors have access to me, email, they have my cell phone, they can text me, they can call me. I literally have investors call in the middle of the night. Please don't do that. Always happy to jump on a phone call or a Zoom call if you have questions either before or during the investment. So.
Great. I'm going to give it like another minute to just ask some questions. Just drop them in the chat if you guys have them. I know this is an extensive presentation, and so I think the majority of the questions that I usually get at the end of one of these calls has been covered. I love the sensitivity analysis that Jay put in. I asked him to make sure that was in there for you guys. For me, it's just really cool to see how the upside is massive, right? There's a huge upside. I also love the 4.5 million that you talked about, Jay. Like if you, even if we use half of that, you drop another $2 million on the back end of the project. That's a significant amount of money because there's no difference in debt. That's all upside potential in a project like this. So let's see. I got a question here. Would you be able, okay, so I got a question saying, would you be able to share the status of the loan approval at the end of the day or wherever it happens? Absolutely. I would say just from my side, if
Yeah.
once Jay gets that, there's going to be probably some updated numbers. If it comes in better than expected, that would be a huge upside for us, right? So Jay, anything else on that?
Yeah, I'll absolutely. I'm kind of excited about looking at my email after this call. Hopefully, we'll have some good news. But yeah, anything that changes, any requirements that come out of that approval, I'll definitely let you know, and I'll let you guys know as soon as we have approval and are formally moving forward, which again we expect in the next couple hours.
Great.
Richard has a question. I'm sorry, I don't mean to jump over you, Bill. But he asked, where in the capital stack is this new raise versus the first round? Both rounds are exactly the same point in common equity, so we don't differentiate. First round doesn't get paid first. This round doesn't get paid first. All investors, while they do have different structures because there was a different risk of investing in the first round. It was before the loan was approved, so there was a little bit of additional risk, a little bit different structure, but all investors fall in the exact same place in the capital stack. Nobody gets paid before anybody else when it comes to first or second round investors or the fund.
All right. For some reason, I wasn't seeing all the chat here. So there's some questions in the chat. Okay. So number one, I saw something about recordings. It was answered in the chat, but we will share the recording. So if you're still on here and you want the recordings, absolutely. And if you just, you missed half of it or so, we'll get the recordings out to you. As soon as it processes, I'll upload it to YouTube and then email it out to everyone.
Patrick asks about bonus depreciation. Yes. So bonus depreciation is back 100%. We also do cost segregation. What we are expecting is that over the life of the project, meaning 2027 and 2028, those 2 years, and if we sell in 2028, obviously this won't apply, but if we sell in 2029, this will be 7 and 8. We expect probably somewhere around 60 to 70% of your investment will come back in depreciation. So expect on 100K investment that 60 to 70,000 will come back in depreciation. Most of that coming back in the year 2027, because for the most part, we're going to have most of the units online in 2027. So that's the point at which any money we've spent on build costs will be depreciable.
Okay, so I got some emails coming in from some of you guys that are in. This is fantastic. I love seeing that. Welcome. So Ron asked a question. I'm just going to address it here as the group. The vetting process to confirm accredited investor status. You're saying his accountant charges too much for a smaller investment potentially. There's a bunch of like online softwares. We can direct you to some of those. That'll do it. Just depending on where your money is, if it's easy to fill into an online tool versus having your CPA or your accountant or a tax attorney do it for you, or even financial advisors. There's lots of different ways that you can get an accreditation letter. However,
and how about this? I'm going to throw this out as well. So we work with a company that we do a lot of business with, and so it's really cheap for us. We'll pay for anybody's accreditation letter if you're going to invest.
That's great. And it's just an online software, right?
Exactly. So you're either going to say you qualify with your income. If you say you qualify because you make 200,000 a year, 300,000 a year with your spouse, they're going to ask to see your last 2 years of 1040s that show 200,000 or 300,000. If you say you have the net worth over $1 million, then they're going to ask what your assets are. They may ask for some proof of value of those assets, like brokerage account statements or an appraisal if it's all real estate, et cetera, et cetera. But it tends to be pretty quick and easy.
Beautiful. So reimbursement of the small fees for the
not even
accreditation.
reimbursement. We'll pay it up front. we'll pay it.
Okay, beautiful. That's great. Um, okay.
That's a good question there. What if we invest over 200K? Do we still need the accreditation letter? So technically, you do not. This is a new SEC rule where basically, if you invest over 200K, you can self-accreditate. I don't know if that's the right word, but that's up to kind of Bill and Adam if they want to allow that. But technically, that's legal where you don't need to collect an accreditation letter if they're investing over 200,000.
Love it. Yeah, I'm fine. I'm totally fine with that. Uh, okay, a question about the presentation slides. Yes, we will include the presentation slides along with the email from the recording itself. And then bonus depreciation. I know you covered 100% bonus depreciation and the years. So expect obviously year 2 and year 3, and then remember there is going to be some of the after sale. There's going to be a recapture of that as well. So just keep that in mind when you guys
Yep.
are investing. I think this is a great net worth investment. I think there is some benefit of bonus depreciation, and then my goal always when we're distributing capital back to any of my investors, it's me making sure that I have a really good deal on the hook and I'm telling you guys where I'm putting my money. I like to do the poor man's 1031 where I sell and then I just put all of my money back into another project that gives me bonus depreciation. So that's my game right now.
Yeah, and it's worth mentioning this project has been delayed about 2 months. HUD was closed during the government shutdown. So we had hoped that we were going to be 2 months further along as of right now, but that would have put our sale in the fourth quarter of 2028. And one of the concerns that we had some investors have was if they get their money back at the end of 2028, it doesn't really give them a good opportunity to reinvest it to kind of do that poor man's 1031. One of the nice things and one of the reasons we're going to focus on Q1 of 2029 is it then gives you 3 quarters to figure out what to do with that capital and find a great place to put it to defer gains even longer.
Beautiful. Let me look in the Q&A. There's some Q&A box. Okay, got a question that said, are the 5% and 3K fund fees annual? No, they are not annual. The 5% is one time, and then the 3K is annual. So the 3K is the annual fee. What percentage of Amazon workers do you anticipate to be able to afford the rent rate? Any other major businesses around the area who may have professionals you may target as potential renters?
That is a great question. 71%. I know the answer. So based on, and it's a very rough analysis. We know that it's an Amazon operations facility, not a distribution or a warehouse. It's an operations facility. So they do have a lot of white collar workers. What we did was we took the average salary of an operations facility worker at Amazon in the Dallas Fort Worth area, extrapolated that to our rents. Basically, they can afford essentially all of our 1 bedroom rents and a couple of our 2 bedroom rents. Again, not highly scientific because we don't know exactly who the employees are going to be or how much they're making. But the just back of the napkin, this is what those people tend to make. This is what we plan to charge in rent. It's somewhere in the 60 to 75% range. Should be able to afford at least our 1 bedroom units.
Love it. So I got another one. As part of my due diligence, I'd like to review the operating team behind the project, including ownership, asset management, property management, all third-party operators. Could you provide an org chart and brief bios for each key party? So I
Feel,
can take that
feel
as
free
it's
to
a
reach
new.
out to me, send me an email, and I'm happy to send you information. Also happy to jump on a call if you want to dig deeper.
Great. And you got Jay's email right there. And feel free to include us. I would love to see that too. That way I can forward it on to anybody else who
Right.
asks.
Perfect.
Okay. It looks like that's it. Any other questions? Saved rounds, last chance. I got a question. Bill and Adam, how much are you guys going to invest in the fund? Great question. So like Jay said that he's gonna like do his percentage based on the demand. I am going to put as much money as I possibly have. So I'd say come February 20th, at least 100K, if not 200. And if I have 300, it's all going in there. So the way that I operate is however much cash I have at the end of February, I dump it all into something like this. When I find a good deal, I just go broke. I put all of my cash that I have available into it, and then I go figure out how to work hard to make more. So I call it burying in my backyard. That's my investment strategy because I know if I invest in this, it's 3 years later before the boomerang comes back, and hopefully it comes back twice as big. And
I do
then
the same thing. I always say I'm one of those people that money burns a hole in my pocket, but as long as you put it into an investment, great.
yeah. So at least
Same,
100 grand, but likely
same.
probably closer to 2 or 250 if I can. So it's just it. Hope I'm going to work really hard by February 20th to just fill it up. And so that's my very direct answer. But it will not be any less than 100 grand for sure, and likely 200 plus. Um, Great question. Okay. I think that's all we got. Thank you guys so much for being here. I really appreciate it, putting the trust in us and letting us introduce you to Jay and his team and a deal that we want to do together. And I'm excited to do this. It's usually I'm one of the GPs on the project that I'm raising for right now, and this is frankly and very openly, honestly, the first time I've done something like this, like a fund that's investing into a project. I'm really excited about it, and to kind of blaze the trail for the future of doing this with really great partners like Jay. I would
Yeah.
love to
And
do
even
more
if you don't
work.
have any questions, if you're just going to be more comfortable, like reaching out and talking to me or jumping on a Zoom with me, if that's going to make you more comfortable, don't hesitate. Happy to just jump on and say hi.
Awesome. All right, everyone. Have a great day. Thanks for being here. We'll see you soon. Bye.
Thanks, everybody.